Welcome to CFO Squared, hosted by Karl Baker, with Baker's CFO Advisory conversations for business owners focused on growth, structure, cash flow, and building stronger businesses. Today's episode starts now.
I have clients say to us, Karl, you're a CPA. I need help with taxes. I need help with my business, getting my tax return done. And so many people come to me as a financial person to get help with taxes. Taxes are important. Taxes are one component of a business owner's journey in running their business, in wealth management. But it's just one component of it. We could have an hours-long meeting and not talk about taxes. Taxes are important, but it's not the only thing. So what I wanted to do today, I do a series, as you hopefully know, I do a series on YouTube and on podcasts around growing businesses and things that business owners should be paying attention to. And you can find that on YouTube. But today I wanted to talk about things that are on business owners' minds in terms of running their business more effectively, and as it pertains to their own wealth accumulation and wealth management. So, hello, my name's Karl Baker. I own Baker CFO Advisory, and we talk about these things all the time with clients. And I'm joined today by Andrew Goodall, and I'm going to just turn it over to him and let him say hello, and then we'll continue the conversation.
Well, thanks, Karl. It's great to be here. Happy to share a space with you and just kind of learn a little bit from you today. And then if I can provide some value, perspective, insight, happy to do that. I'm a financial advisor with Morgan Stanley here in Springfield. I work with the Ozark Highlands Group. It's a five-member team here in Springfield. And prior to this, I worked with another firm for a few years before I moved over to Morgan Stanley. And prior to that, I have about 12 years-ish in higher education administration. Before that, I worked in banking, loan operations, retail, that sort of thing. So a little bit of breadth of experience, some pretty different careers, but it all ties together well.
Right. Well, it helps you with communication. It helps you with providing advice to business owners. And Andrew and I have gotten to know each other over the past couple of years through just networking in our community. We actually did, just so you know, we did this presentation in a little more official perspective live a couple months ago, and we decided this is such a relevant topic to his client base, my client base, people out in the cyberspace, that we wanted to just do a live or a YouTube session. We'll turn this into a podcast, and hopefully it will help people. We're both all about educating and just helping people with our skill sets. And maybe there will be a couple nuggets in our session today that will help you. So let's get started. What I want to do is talk about things that I think are germane to business owners, as I mentioned in my introduction. And we sort of split this up into three categories. And those three categories include taxes and business planning. And then we're going to segue from there into protection, asset protection from a business perspective and also from a personal perspective, some wealth planning in that bucket as well. And then eventually a business owner needs to figure out what to do with their business. And that might mean hopefully not just simply closing it down, but some sort of organized exit. And so we'll talk about how all these issues sort of roll up into that final exit plan and what are some of the strategies. As we navigate through all of this, each one of these topics could be something that we spend 3 hours on in each perspective. So we'll be fairly fast-paced, high level, and we'll feel free to reach out to us via email. We'll put contact information. We'll talk about that at the end. But each of us would be more than happy to have a conversation with anybody about these topics in more detail. There will be an opportunity for some comments, and we'll give contact information. You can get with us, and we'd be happy to have that conversation. So first, as I think about, as we segue into this, as I think about what clients come to us for, it tends to be it tends to be a situation where a business owner's objective is to have true profitability but pay no taxes, and that's a very common scenario that we see. And so we want to talk about other things that we think business owners might be missing, and maybe a different way to think about that. But that's a very common thing. So instead of trying to avoid taxes altogether, we're going to talk about ways to manage the economics of your business a little more effectively, and manage risk from a structure and asset protection basis. So that's what we're going to talk about. So let's talk about first, as we move into the subjects, tax and business planning. And as I said, we did a presentation, a live presentation, and in that session, we did some slides. And my first slide was tax tail wagging the dog, and I've sort of alluded to that, where people come to me to try to, quote, avoid taxes. And what are the strategies that we're missing, Karl, to make sure that we don't pay any taxes? So my problem with that is that that will lead to decisions that might have negative implications. So that causes people to make decisions around well, I'll just give a classic example. The classic example I think of is a person trying to avoid taxes by, at the end of the year, say December 27th, going out and buying a truck. That's a classic example. Somebody buys a truck at the end of the year so that they have a deduction so that they don't pay any taxes. And my first response is, well, did you need that truck? Is there a reason for buying that truck? Maybe you should have bought the truck next year. There are different planning, but a lot of times people, I hear that all the time. I bought something at the end of the year to just buy to save in taxes. That creates liquidity problems, perhaps, and just other problems. So we say manage your organization in a way that most effectively aligns with the economics of your business and making sound financial decisions, not just to avoid taxes. And there are other things around that, but I'll just sort of continue on with this. It also, relating to that, besides the tax issues, and I've alluded to it, it could also impact your liquidity. It could cause you to show financial results on your tax return that aren't the real economics of your business. And your tax return also might be showing no profit. And then if you have aspirations to grow, that eventually means you probably will need to seek financing, and you go to a bank and you ask your banker for a loan so that you can buy a new building, buy more equipment that you need. And the first thing the lender is going to say is, okay, show me your financial statements, show me your tax return. And if you show them a history of years of poor results from a lender's perspective, they'll say, well, you're not making any money. And then you're tempted to say, no, we're making money. We just don't want to pay any taxes. So our tax return shows no income. Well, trust me, the lender's going to say, well, we can't make a decision on what you say. We're going to look at your tax return. And according to your tax return, it doesn't look like you have funds available to pay the debt service. So that's going to be a hard pass for us. So we just think of, we advise clients to think of that differently, and just make sure that you are strategically thinking of your business from that perspective. Any comments there, Andrew? Have I missed anything?
No, I think I'm tracking with you pretty well. I think one of the things that we see in our sector is when we're helping clients grow their wealth, there are times where a desire or a perspective by the client that they want to avoid seemingly at all costs short and long-term capital gains
Hmm.
in some of their investments can be a hindrance, especially in the kind of fast-moving markets that we see now, where rotation between sectors and cycles is quicker than ever before. And the goal should be to reduce your taxes as much as possible when it comes to short-term or long-term capital gains. We're not going to be able to eliminate everything, because if we eliminate everything, it means that you're not growing the way that you should be. If you're making money, you're paying taxes. So we try to get clients to get comfortable with the fact that they're going to have to pay some, they have to pay some taxes, some short and long-term gains. But if our net return is higher than what we've projected year over year, and the taxes have to be paid, so I'm saying net, obviously,
Hmm.
then who cares? I mean, the idea is that we're making money, and sometimes we have to move fast to do that, and we're going to be able to show as much of a loss as possible in some cases, but at least reduce them. So I think elimination, to your point, is what gets people in trouble, because they think, I just want to pay no taxes. I'd rather see you pay a little bit of taxes and have huge gains.
Right, right. I think of a person contacted me recently, and they said, I have a new business, and this tax game is new to me, and I want to make sure that I don't pay any taxes. And I want to talk with you about how to do that. How do I avoid taxes? And my response is, well, I'm not in the business of helping people avoid taxes. I'm in the business of helping you report the economics of your business properly and report your taxes properly. I don't want
Yeah.
you to overpay. I don't want you to underpay. I want you to pay the right amount of taxes in accordance with the law. And so we want to do it the right way, not just avoiding taxes. So
Right.
I like what you said, and appreciate what you added there. All right, so let's segue into the next category, which is uh, talking about how to manage your business from a risk management perspective, an asset protection perspective. And we had several categories underneath that umbrella, the second umbrella, and it was asset protection errors, insurance, saving strategies. So I'll just ask you, Andrew, to help us think about those issues from a business owner's perspective a little more effectively.
Yeah. So in our industry, one of the things that we talk about, I guess I shouldn't say our industry, can't speak for the whole industry, but one of the things that is a common phrase used among our team is that we are here to help clients grow their wealth, protect their wealth, and pass it on. And so the middle part of that is protecting their wealth, which means, from an investment strategy, limiting downside risk as much as possible. Um, Always following guidelines for suitable investments, suitable risk given the investor's objectives and timeline. Within those parameters, um, we want to make sure that the job that we're doing is ultimately completely confined within. We're still going to protect it at all costs. There's not reckless activity, and so part of that protection piece that evolves over time is for business owners. There is no guarantee of tomorrow, as we all know.
Mhm.
And if that is actually true, then it's not enough to just be growing your business. You know, Focusing on 100% aggressive growth, scaling up, and then once you feel like you've gotten to a plateau, then kicking back, feet up on the desk. That just means that your protection needs have changed. And so, for a business, beyond the liability piece of it, property and casualty, things like that, we look at, okay, what are the areas that we need to make sure are have safeguards in place if something happens to your health or your life. How is your family protected? How is your business going to continue? And how is the value of your business tied to or compared to the value of your personal wealth? We have to differentiate those. We just do. Even though the two may conjoin at some point later on,
Mm-hmm.
with a lot of factors, sometimes businesses can't be passed on or can't be sold. And when that is the case, if the investor has not protected their own wealth journey by having a separate sector or a separate, we call it like when the train leaves the station is when the wealth journey begins. For business owners, oftentimes there's two trains leaving the station. One is the growth of the business and the value of the business. The other train is their own personal retirement portfolio or wealth strategy. If that personal one is neglected, then if this train at some point it gets derailed or just shuts down and this train never left the station, the owner is not protected.
Yeah, as I was thinking about that, I wanted to contrast what is a typical life journey like for a person that just has a job. They have a W-2 job. They're 30 years old. They work until they're 60. What does that journey look like versus a person that is a business owner? And what do I mean by that from a savings perspective and a wealth accumulation perspective? What does that typically look like? They earn a wage, they take some of that wage and they do three things with it. They hopefully, maybe I encourage people to do some giving. So that's bucket number one, not necessarily in this order, but there's some giving. There's just regular bill pay. And then the third thing that a person is doing with their W-2 wage is they're saving some of that. And they might be doing that pre-tax through a 401k, through post-tax, through just a regular investment portfolio. They're doing something to plan for the future. And there's just a natural stream of money coming in through that W-2. And, they're hopefully working with somebody like you or somebody within their sphere of influence to help them with that. But that's a fairly common wealth accumulation strategy for somebody that's just a regular employee. Contrast that with a person that says, I don't want to be an employee. I want to own my own business. Very often they put all their eggs into that one business basket and they stop that savings plan. Maybe they just put all their money back into their business and their business becomes their long-term savings plan. And I think what you're saying is there really needs to be two paths there. And the only way it sort of resonates with me is to think about the traditional W-2 employee and what they typically do versus the business owner that ties up all their resources into their business and don't think about that wealth accumulation from a personal perspective.
Yeah, completely agree. Yeah.
Yeah.
You can't, business owners don't have the luxury to neglect one over the other. They have to be maintaining both of those trains, adding coal, adding fuel, maintenance. Both have to be happening.
And typically people that are in a business or running a business or owning a business, they're doing it because they think they can make more money as a business owner than they can as a W-2 employee. And therefore, not always, maybe they want to just have independence and quote, not have a boss, but usually there's some financial aspect to it. And my point in saying that is, you would think they would have an opportunity then, if they're making more money, they would have that much more of an opportunity to have a wealth accumulation plan, a wealth management plan. So just a reminder that the business is not the only retirement plan available to you, and you really need to think about both. The other thing I would say is, and I don't know if you want to comment, but I'll make a comment from a business risk management perspective. I'll throw in the concept of what sort of corporate structures to set your business up with. I hear all the time, I've had it I've had it said to me as recently as this week. People think, I start a business, I need to set up an LLC, and I need you to help me with my taxes. And I usually throw out a reminder that the corporate structure is in place, especially at an LLC level. That corporate structure is in place for asset protection, for your balance sheet protection, but it's not going to save you money in taxes. There are other corporate structures that might be available to you that will save you taxes. And I'll just throw out another concept here that's on my mind because it happens all the time. That idea of setting up an S corp, a corporation which will feel like an LLC, where you pay taxes at the individual level instead of at the corporate level, but you will save taxes. People out in cyberspace and other places, they think, I've started a business, I need to have an S corp. And I'm here to just tell you, as a quick reminder, as you're navigating through your business, there's a right and a wrong time to set up an S corp. Many people will default to an S corp, and that's not always the right answer. So my point in saying all of that is, when you start your business, or as you're navigating through your business, talk to somebody like Andrew or me to evaluate what is the right corporate structure. It might be a corporation, it might be an LLC, and there are tax reasons for setting those up. There are asset protection and legal reasons. Neither one of us are attorneys, so I throw in the caveat that we're not here to give legal advice, but there are reasons for setting up corporate structure, and there are ways to think about all of those things, and there's a right and a wrong time for all of those. So those are other things. Anything else you want to talk about in terms of risk management, wealth accumulation? Anything there, Andrew, that we've
From a protection standpoint, I think, to give people specifics, there are two pieces that are a part of the protection plan, protecting the wealth, and that's life insurance and long-term care. And for clients of different ages and different familial structures, family structures, I don't know if familial is the right word there, but so if there is a spouse, if there are children, if they're, whether the age bracket is 30s, 40s, 50s, 60s, it's a different combination of the two. But getting back to, if a person's health declines or erodes drastically, or they pass away, the business doesn't matter. It has to be passed on or dissolved. And so without those two things in play, you can have the most successful business ever. But if you haven't protected in that way, those are very important pieces of the overall financial plan.
We haven't talked about this, so I don't mean to put you on the spot. What's your experience with or familiarity with key owner executive insurance? Any comments there?
That's definitely another piece that a lot of times business owners neglect as well. Whether it's key employee insurance or if it's what we'll call a partner protection plan, where you may have two or more partners in an LLC that also have families, and there is a desire for there to be a division of the ownership of that business if one partner or multiple partners were to pass away unexpectedly. And so there's different structures that can be set up to address both of those that are very painless, very easy, and very cost effective when compared to the lack of not having that. So it's something that bears a conversation.
Yeah, and I'm assuming, like I said, on the corporate structure, there's a right and a wrong time to evaluate when it makes sense to purchase key employee insurance. And so just logging it in the back of your mind that that's another thing that's out there as a tool for business continuity protection, for business protection, and it's just another resource available to you to keep in mind. All right, so as we think about then what happens if once you have this business in place, you've properly evaluated your business from an economic perspective, from a tax perspective, from a wealth management perspective, you're properly managing your business balance sheet, your personal balance sheet, and your business plan and your personal wealth plan, and all of these things that aren't to be evaluated in a silo, but collectively for yourself and for the business, for its ongoing concern, for your family and all of that. But eventually, at some point, you want to think about selling your business or transferring it to a family member. It's also a truth that sometimes businesses just close. But if you're thinking about in some fashion exiting the plan, that's the third bucket that we want to talk about today. So as we think about succession planning, I guess my overall and first comment is it very often happens too late in the process. So that's why we're talking about it today, to encourage you to think about succession planning and that exit plan sooner rather than later. And if somebody, and I just use an example, if somebody is 60 years old and they want to exit the plan and start to head to the beach or retire or do something else, the age of 59 is not when you start thinking about succession planning. You start to think about that well in advance. You might have a plan in place. You probably ought to think about how and who you might want to sell to. Are you grooming family members to have the expertise to run the business? Are you grooming staff members, non-family members? Are you mentoring them to not only take over the business, but to purchase the business? There might be other opportunities. If you plan to take your business into the market and sell to a third party, whether it's just a business investor or a private equity firm, putting those plans and thinking about those plans and what the implications are and what needs to happen to make those exit plans effective for both the business and for you personally, doing that sooner rather than later is important. I'll stop there and let you comment, Andrew, and then I have a couple other points around that.
Yeah, I think the main point to focus on is the timing and the preparation.
Mm-hmm.
Preparing a business to either sell or to pass on usually always involves either, yes, you're selling it to a family member or someone else, and what that payout structure looks like can take on a few different forms, but the preparation takes years and many years. I mean, it could take 5+ easily if done right. And so business owners, right. I'll just reiterate your point. It's a great point. Starting way too late is such a common hurdle that many business owners create unnecessarily for themselves.
Yeah, let's talk about what happens when you sell that business. By and large, two things. The first thing is, what's the sale price? How much are you going to sell the business for? Well, that's based on a valuation. That valuation, every business has its own typical way that valuation is calculated, but it's usually some version of total revenues. It's usually some version of what the owner's cash flow is, some version of that. Is it 1 year's worth of revenues, 3 years of profit, something like that? Well, so let's think about what we talked about at the beginning with a person that wants to avoid all taxes by reporting no earnings. All those years of reporting no earnings on their tax return is going to come back and bite you if you now try to seek top dollar through evaluation where that valuation is going to be based in some version on revenues, but also on profitability. Neither of those will be looked at in isolation. So there will be a view of what your revenues are, but also what your profitability is. So if you've shown no profit for the last several years, that's going to come back and materially impact your valuation. So think about that as you're navigating through your tax planning and views on taxes. Secondarily, other components that will impact the valuation, and I had said there's a couple of things. One is the valuation. Things that relate to that include your financial reporting. So the second piece of valuation is you leaving the business and somebody coming in and taking it over. And when that happens, somebody that comes in to take over your business doesn't want to have to figure out how the business is run. They don't want to figure out what are all the processes. They don't want to reinvent. The whole point of buying a business is to take advantage of all the processes that have been built so that doesn't have to be figured out. Also to buy the customer list and all of those things. So if you don't have memorialized processes, and that is in relation to how you conduct business with your customers, with your clients, how do you manage your HR policies? How do you hire people? How do you manage your accounting? How do you manage your sales and marketing process? If you don't have a good set of processes memorialized, that too will impact your valuation, because if a business owner comes in and says, we have to figure all this out, well, what's the point in buying your business other than the customer list? So it could materially impact your valuation. Other things to think about include customer concentration and the existence of recurring revenues as opposed to one-off revenues. The more you have of that, the more diverse your customer base is. All of those things will impact valuation. But really, the things that I see on a day-to-day basis when business owners are thinking about exiting their business include the memorialized processes, in financial reporting, taxes, and other sales and other processes. The more of that is memorialized, the more effective your organization will be teed up for sales. So I think that's a long-winded way to answer that question or that comment. Anything else there, Andrew?
The only other thing I'd reiterate again is, one thing that we hear a lot about is that business owners, when they're ready to sell, are typically confronted with the fact that they need to be able to show multiple years of profitability in order
Yeah.
to raise the value of their business. That's the thing that matters more than anything else. And so working with someone like you is high value in that, in order to be able to find out, how do I not so much increase revenue or, assets or, things like that. Acquisitions matter that come down to profitability for the highest valuation. So great point.
To what extent, again, we didn't talk about this specifically, so I don't know if you have any comments, but to what extent does estate planning and the timing of estate planning impact a business owner's exit, or to what extent does that factor into their overall business plan and financial wealth plan?
Our standard practice is to try to connect clients with an estate planning attorney
Mm-hmm.
as early on as possible. It just helps simplify things,
Right.
and the estate planning attorney, working in conjunction with a CPA and a wealth advisor, is what we call the holy triumvirate. I mean, uh, those three entities are going to be able to have perspective that really sees every side of a business owner's personal and professional life in a way that makes things mesh in ways that will prove so cost effective and productive years and
Right.
years down the road. So I would say
Right.
sooner rather than later is always the time. And then, of course, we defer, then to the experts in each
Sure.
industry.
Of course. Yeah. Not to mention, um, estate planning can be a time consuming process. So the sooner you do that, the better, because there's some work involved
Mhm.
in identifying your assets, getting paperwork done. So the sooner you tackle that, the better, because it could take a bit of time to do all that. All right, very good. Well, we've talked about business planning, managing taxes. We've talked about wealth accumulation, wealth management. We've talked about business uh, risk management from a business perspective and from a personal perspective. We've talked about how all of that culminates into an exit plan and how they impact the success factor around selling a business, exiting a business. So there are some common denominators around all of that. You might be in a situation where you're not thinking about growing. You might be in a situation where you are thinking about exiting. In both of those cases, there are some factors that will contribute to success, whether you're not thinking about exiting yet or you are thinking about exiting yet. In all those cases, I think just doing things from a professional and right way. That means setting up your financial reporting in a proper way, that such that your financial reporting aligns with the real economics of your business, as opposed to just avoiding taxes at all costs. So making sure that your financial reporting is proper, effective, accurate, reflects the economics of your business, and that will contribute to your success. If you're trying to grow, then you'll be properly positioned for financing, for accessing working capital, for accessing capital. In that subject, I always talk about a phrase that I use called financing positioning. You'll be teed up to be prepared for financing and growth strategies. If you're planning to exit, then putting all of those strategies in place will help you in that regard, from a valuation perspective, from a transition perspective. So those things will help you in that regard. If you are properly managing your risk factors and your wealth accumulation and wealth management perspective, then whether you're seeking to grow your business or whether you're seeking to exit your business, you'll be properly set up for success. So I can't impress upon you more the importance of throw in a little plug, surrounding yourself with advisors, but just managing your business holistically and comprehensively, not just from a myopic business perspective, but or a tax avoidance perspective, but thinking about it prospectively or comprehensively from a business and personal perspective. Andrew, I'll give you the last word there, and then we'll say goodbye.
Yeah, thanks, Carl. It's been great to be part of your podcast today. I appreciate you having me on. I think, more than anything, my takeaway again and hearing you share your expertise is how important proactive planning is for business
Mm-hmm.
owners. It's something that feels very similar with every nearly business owner that we work with, and that's the high value of time. And the idea of taking an hour or 2 hours here and there just is very difficult for many business owners, I understand. But when it's not done and it's not revisited on a regular basis, the hurdles and the stumbling blocks that it can create down the road are, again, it's all about the effectiveness of time and money and how the two correlate. So proactive planning, intentional planning, and seeing the value of time in both of those aspects, I think is huge when you talk about growing your wealth, protecting it, and passing it on, especially for business owners.
Yeah, I couldn't agree more. When I started out on my business journey, where I left my corporate career and started running my own business and sowing the entrepreneurial uh, wings, the entrepreneurial oats. Somebody told me that one of the hardest things about running a business, you can get stuck in the details, is to step back every once in a while.
Mhm.
And they used a phrase that has stuck with me for almost 10 years now, which is having stare out the window time, the strategy time. And that's honestly the difference between being a worker and being a business owner is you're not just doing tasks, you're running a business. And that does involve staring out the window, thinking, strategic planning, and risk management and wealth management and all these things.
Yes.
So very good. Thank you, Andrew. Tell us where we can find you.
They can definitely find me on LinkedIn, and my email address at Morgan Stanley is probably the easiest way to get in touch with me. If there's any follow-up questions or anything that I can clarify, always happy to do that. Andrew.Goodall@morganstanley.com.
Very good. And same with me. I tell people my email address, Karl with a K, Karl@BakerCFOadvisory.com. All my contact information is on our website, BakerCFOadvisory.com. Happy to have a conversation. We'll do our best to make sure that contact information is in the show notes. You can also find me in LinkedIn. Good reminder, Andrew. I don't talk about that a lot, but you can find me on LinkedIn, Karl Baker, Karl Baker, I think. Until next time, we'll see you again. We're going to do these periodically where I have guests. Maybe Andrew and I will pick another subject and we'll talk some more and talk about things that are important to business owners. So stay tuned and we'll see you next time. Thanks a lot for watching. We really appreciate you taking the time. And until next time, we'll see you then. Thanks a lot. Bye-bye. God bless.
Thanks for listening to CFO Squared, hosted by Karl Baker with Baker's CFO Advisory. If you found this episode valuable, be sure to subscribe and share it with someone who would benefit from the conversation. We'll see you in the next episode.